In this video, we'll take a quick look at some of the market value ratios for McDonald's and Johnson & Johnson. Especially given McDonald's negative shareholders' equity, it's important to look at some things that are actually a better measure of the value of the firm than traditional accounting values. In the balance sheet, what we can see for McDonald's is the liabilities exceed the value of the assets. Now remember, all these numbers are on historic cost basis. So it doesn't mean that the assets are actually worth $31 billion. All right, so when we record $31 billion of assets at cost, that's basically what they were paid for. That doesn't mean what they're worth. So McDonald's might own some land in downtown New York City that it paid $10,000 for, 50 years ago to open a restaurant, and today that same land might be worth, 1,000 times as much. But on a balance sheet, it's going to be carried at historic cost, and that's why we look at market value ratios, because they reflect current market value or perceptions of market value. And if we look at the values of the firm, if we look at some of the measures we have in here, like the earnings per share. Earnings per share takes the net income and divides it by each of the shares, so we have an idea of what each of the shares would have earned. All right, and because McDonald's has been cutting way back on the number of shares, that helps maintain or strengthen the earnings per share, and that's one of the reasons companies buy back shares of stock, is to prop up earnings. In this day and age, McDonald's can borrow at 2%, and if the equity holders, the people that own shares of stock, are earning 10% from McDonald's, well, if McDonald's buys back the shares of stock, then that's 10% they don't have to pay out, and it only costs them 2% to borrow the money to do it. Well, too much of a good thing is too much of a good thing. And what McDonald's has been doing is buying back a lot of shares of their stock using a lot of financial leverage. It's sort of the equivalent of somebody who has equity in their home, taking out a second mortgage and borrowing out all the equity and then some. That's really a high-risk proposition for individuals unless you're rich. Let's say Warren Buffett did it. If Warren Buffett owned a house worth $1 million and he took out a $2 million mortgage on it, we wouldn't bat an eye because his cash flow is good enough to service the mortgage payments. What he's doing is taking out equity in the house so he can deploy it someplace else to earn a higher rate of return. So that's reflected in the share price for McDonald's. It was hovering in the low $90 range for these years, and then beginning in 2015, 2016, it started to improve. Share price looks at what a company is worth going forward. The share price, the valuation of the company, is a going concern, forward-looking number, whereas things like return on equity are looking backwards, and we're comparing net income that we had in the past year to historic value of shareholders' equity. That doesn't tell you the same thing as the share price. That's people voting with actual dollars about what they think McDonald's is going to do. Since we can look at market capitalization, and that's a measure of the actual economic value of the company, we could see that it's actually increasing for McDonald's. So not as dire a situation as negative equity might otherwise be. Negative equity isn't necessarily a good thing, and usually it's a bad sign. In McDonald's case, the jury's still out. It depends on what they're going to do going forward. On the other hand, we look over at Johnson & Johnson. Johnson & Johnson was issuing some shares here, and then they have bought back some of them. So they have a little bit of the same activity in the treasury stock, but it pales in comparison to McDonald's. McDonald's bought back 15% of their shares, and Johnson & Johnson, while the share count is down from its peak here in 2014, it's essentially unchanged from where it was back in 2012. And the earnings per share are actually higher on a real basis compared to the same number of shares and the same number of shares. And we can see that the share price for Johnson & Johnson's actually doubled, or close to doubled, in this time. All right, going from roughly $60 to $110. So from a market value basis, we can see that Johnson & Johnson has added more value to shareholders' contributions. That's the market value added. And some of that's going to be reflected in the price per earnings ratios. That measures the dollar that you will pay for a share of stock relative to the amount of accounting earning that it has. Now, accounting earning is often kind of messed up in some ways in the short run because of short-term accounting practices, such as accounting for salaries that are paid with non-cash compensation. And that's why sometimes we look at the price over the net cash flow or the free cash flow per share. So if I take free cash flow, which I'll pull from the other financial sheet, free cash flow is an alternative method of measuring income based on cash flow available to the shareholders and the debt holders. So this is a measure of actual dollar bills in the company, and if I measure that per dollar of shares, then this number is not directly comparable to net income, but it gives me a different perspective on income for this particular firm. All right, so cash flow, free cash flow per share for McDonald's has actually improved over the last 5 years. And if we look over at Johnson & Johnson, we could see that there's some improvement over there with them as well. But the free cash flow per share is a lot different than we're seeing with the earnings. And then if we got a price per dollar of free cash flow, and that takes the average share price divided by free cash flow. This gives you a better indication of what people are paying for the cash portion, and it's actually a little bit more stable for McDonald's and looks like it's actually higher than Johnson & Johnson. And that could be a reflection that people think that the McDonald's turnaround that started a couple of years ago is actually going to be result in a bigger rebound for the firm. And with Johnson & Johnson, they just keep plugging along and have been for over 100 years because they're a stable, long-term growth company. And with McDonald's, they had a bit of a slip and maybe they're recovering from it. Gives you a different perspective on numbers in here to look at various ratios. Again, the ratio itself doesn't tell you anything. It tells you where to look for further answers, and after that, a lot of the analysis has to become fairly subjective. So higher or lower ratios mean nothing. What you want to do is understand why the ratios might be higher and lower. And with McDonald's, more than likely the higher prices on McDonald's per share probably reflect the investor optimism about what the future holds.